Alright guys, so let's talk about the economy today. So everyone is breathing a sigh of relief that the Fed isn't going to hike rates further, and sure enough, the markets rallied. But is that what we should really be cheering about? The real concern is this limbo where inflation refuses to come down and the Fed simply can't cut rates. Powell keeps rate cuts on the table but leaves timing less certain. What investors are cheering is the fact Powell said hikes are unlikely, but digging into the meeting, we'll see that even he doesn't know what to do. He can't guarantee we'll get a single cut by December this year. I can just say that when we get that confidence, that rate cuts will be in scope, but I don't know exactly when that will be. He also didn't mention if rate cuts would happen this year, which is highly ominous, and this leaves rates still at 5.5%. This isn't good for our leverage economy. The big problem now is the signals Powell is getting. Inflation is strong and the drivers are still alive and well. The whole point of Powell's higher for longer is demand destruction. He needs to see spending come down meaningfully, but that simply isn't the case. The inflation progress has effectively stalled in Q1. Looking at the PCE price index, which is the cost pressures on US consumers, it is looking very horrible. It has rebounded up to 2.7% today. If we strip away energy and food, it's even worse. 2.8%, which is another rise from the previous month. And this is what happens when you have endless government spending and rising energy prices from two endless wars. All this is feeding the inflation fires, is making the cost of everything go up. Now, one statistic the Fed watches closely is the labor cost, how much it takes to hire someone in today's economy. And what we are seeing isn't encouraging at all. Labor costs have accelerated the most in a year. We are back at a 12-month high of 1.2% this quarter. And this tells the Fed that people are earning more money and wage growth is robust. Rising labor costs also aren't good for companies long term. It is a signal that hiring is getting more expensive and the knee-jerk reaction is to pass the cost down to consumers. So we are still getting this endless inflation feedback loop that's pushing prices higher and higher. People still have money to spend in the economy. But dig a little deeper and you realize things aren't that rosy. The unit labor costs have jumped by an insane 4.7%. This is horrible for companies. And this means to produce one unit of output, the cost is now almost 5% more. And who do you think will pay for it? The consumer, people like you and me. We are going to get clobbered again. When the unit labor cost rises, it collapses productivity. We can see this big drop down to 0.3%. Companies are no longer productive because of inflation. To hire workers, they have to pay more, but the output is either the same or dropping. This isn't great for the underlying economic situation. When the cost of labor goes too high relative to output, there will be a rebalancing sooner or later, and that just means job losses down the road. But how can output rise when the Fed is holding rates at 5.5%? It's the chicken and egg problem. By keeping borrowing costs high, you are slowing down the economy. You are taking money out of the system. And the longer you do this, the more money leaves the real economy. The Fed knows this and they are starting to reverse their QT. Powell is going to slow the pace of their balance sheet reduction in June. The sell-off will drop from $60 billion a month to just $25 billion. For nearly 2 years now, the Fed has been selling off their holdings of US bonds to the market. It has gone from nearly $9 trillion down to just $7.4 trillion. They are removing liquidity from the economy to slow inflation down. But the fact they are slowing this shows cracks in the system are forming. We can forget about going back to the levels before the 2020 stimulus money. It simply can't happen without an implosion. When monetary conditions get tighter, people on the street they get walloped. They are going to see their mortgage rates and personal loans stay high. At the same time, because of government spending, prices are heating up as well. And this wreaks havoc on their budget. And when there are a ton of uncertainty, people simply don't want to spend. If you see chaos ahead, you're going to do a lot of cutbacks. US consumer confidence has collapsed in a very big way. It has dropped all the way down to the lowest level since July 2022. This is the third month of decreases, showing households are afraid of spending. If you ask people why, the answer is crystal clear. The labor market doesn't look good, and by extension, the entire economy is looking really nasty. Bidenomics isn't working. The share of people expecting more jobs in 6 months have collapsed down to 11.7%, the lowest since 2011. Expectations for higher incomes have also dropped. The share of people expecting more jobs in 6 months have collapsed down to 11.7%, the lowest since 2011. Expectations for higher incomes have also dropped, and this could come as a blind spot for US companies. They are always the last to react because they have to keep optimistic. They have people on the payroll and they don't really want to let them go. In a survey, almost 80% of business leaders believe the US economy is strong, but just ask the man on the street. Only 40% believe the narrative. That's less than half. This big disconnect signals a storm is coming. Consumer spending could crater the longer the Fed stays higher for longer. And this obviously isn't good for the US. The economy is driven by domestic consumption. If our consumerist society decides to stop spending, everything, literally everything, grinds to a halt. 68% of the US economy is powered by consumer spending. And if the outlook continues to darken, households will cut their expenditure and it could be game over. Now, granted, many other countries are powered by local consumption as well. China's GDP is powered by domestic consumption to an even bigger degree. It accounts for 82% of their economy, but retail sales there are still going up by 7.2%, at least double versus the US. And that's because prices are stable in Beijing, and in some cases, they are actually coming down. And that allows people on Main Street to keep spending and keep the economy afloat. But in the US, it's the exact opposite. Prices are going up. There's high oil prices, the rising cost of labor, and high input costs as well. All this makes consumer goods more expensive, and let's not forget the US tariffs on imports as well. That only makes things worse. But the biggest headwind facing the US economy is endless government spending. And we have said before how government spending is inefficient. It's borrowing a dollar to generate 50 cents of growth. The federal deficit in 2023 was 6.3% of GDP, and that's according to the CBO. So the government borrowed $1.7 trillion to goose up the economy. However, real GDP grew by only 2.5% in the same year. It's evident that deficit spending isn't efficient and there's a lot of wastage. It's not complex math here. A lot of that money is flowing into the hands of the privileged and certain industries. The problem now is that borrowing and spending from the top isn't gonna end. In fact, we now have word from the US Treasury that it's gonna get far worse. Janet Yellen has announced that she has to borrow more money this quarter to run the US economy. She's going to issue over $40 billion worth of bonds more to raise money for Biden's government. And that's a 25% increase from the previous prediction of $200 billion. And this is what happens when you are funding endless wars while trying to battle China's economy all at the same time. You have to give money to Ukraine while subsidizing your industries to compete with Beijing. You create a very big fiscal disaster. And all this adds stress to the system itself. It destabilizes the banks, mortgage payers, and businesses in the real economy. They will be competing with the US Treasury for capital and investment money. And here's how serious things are gonna get. For the current quarter plus the July to September period, a total of $1.09 trillion will be borrowed. And for all we know, Q3's borrowing likely will get revised higher as well. It's important to understand the consequences of this. The money is being borrowed by the government and spent in the real economy. It's not sitting in some bank or in a vault. It is circulating around. And this is countering the Fed's monetary policy of higher interest rates. It essentially locks power in a stagflation trap. He can't lower rates because deficit spending is making inflation sticky. Neither can he hike because it will cause the debt crisis to get worse and even implode the banks. And this is why we are staying higher for longer. Now, what's funny is that the US Treasury knows the economy is suffering under the weight of this endless borrowing. And that's why Yellen is starting a buyback program of their bonds. Beginning May 29th, she's buying back US debt as part of a liquidity support program. She's afraid there's not enough money circulating in the real economy. But it's not going to matter. As long as the government keeps borrowing money and rates stay high, money is still going to leave the system. It will hide in government bonds. The only way to end this doom loop is to reduce fiscal spending, which also means embracing a recession. And is Joe Biden really ready for that? But let's end this with Japan's currency crisis. Now, this is a perfect example of how excessive debt can trap an entire economy. Japan's currency, the yen, has been collapsing. As a result of money flowing to US bonds and the rising dollar, the yen is being dumped. and the Bank of Japan's latest intervention has failed. They spent around $23 billion to prop up the yen, and that means selling the dollar holdings and buying up their local currency from the markets. And this is their second intervention, and the results are very clear. The latest intervention saw the yen rise by 3% against the dollar, but almost immediately it depreciated once again. It gave away almost half of the gains, and this is the big problem with interventions. It won't last for long because the fundamentals are against the yen. Every time the Fed refuses to cut rates, it just hammers away again and again at the currency further. Looking at the previous intervention at the 160 levels, it's clear that it didn't last for long. It rose to the 155 level before slumping back down to 158 against the dollar. Now, don't get me wrong, the BOJ has no choice but to intervene. If they just let the yen go into free fall, this will be an economic and political disaster. So the only solution left is for the Fed funds to come down meaningfully enough to bridge the interest rate gap. But we know it won't happen because Jerome Powell is still fighting inflation back home in the United States. And this situation is important because a collapsing currency makes a country poorer. While it's true that a weaker yen helps exports, consumers in Japan are getting hammered. When your currency weakens, imported inflation rises. So prices in Japan goes up. A ton of things, especially energy, are imported into the country. And this causes people to spend less and hot money to survive. The Japanese consumer is getting hollowed out. Economists predict March household spending to fall by 2.4%. And if that happens, this would be the 13th straight month of spending decline. And this removes export demand for countries around the world, including the US as well. So a currency crisis in Japan does have global consequences for demand. It drags all their imports down. And it's not just the yen falling hard. Many other currencies, especially in Asia, they are all suffering. And this is the problem with higher interest rates. It hurts the world economy, which boomerangs back on the US itself. No matter how big America is, it is still connected to the global economy, to global trade. Exports from the US are already dropping. In March this year, US goods exports fell by almost 3%. The world is importing less from America because the dollar is stronger and everyone else is going broke. Is that really a win for America? When companies in the US export less, they earn less as well. And this in turn affects workers as well. So wage increases just won't keep up with inflation. It's not a surprise that imports into the US fell by 1.6% as well. The US consumer is buying less from the world because they are going broke too. So overall trade has come down. This fire is consuming us all, and the situation won't get any better until inflation drops, allowing the Fed to finally slash rates down. And once again, I need to keep saying this, I need to keep hammering the table on this. The only way for that to happen quickly is for government spending to stop. However, this will mean a global recession for everyone. But let me know what you think. Can the Fed ever cut rates this year? And will the US government stop borrowing money? Let me know in the comments below. Stay safe, be sure to smash the like button and subscribe as we navigate through these crazy times.